Alright, this is Ubaid on behalf of Electronics, and in this video we'll continue with credit risk. Okay, so we learned about some of the risks involved in the banking business. Okay, this had to do with defaulting, bankruptcy, so on and so forth, and ways one could manage those risks. So in the case of banks, for example, they would screen the applicants, they would verify the information via third parties, via financial intermediaries who specialize in that business, okay, and screen the applicants, okay, via making sure that none of the information on their application is fraudulent, making sure and verifying information via credit card companies, via other banks, as well as institutions, so on and so forth. Okay, now another way banks would ensure, okay, let's just say that there is no misrepresentation involved is through collateral. Okay, so another way to ensure accuracy on applications is through collateral. All right, now what is collateral? Okay, as the name suggests, it has to do with, okay, using an asset, okay, as a collateral to give out loans. Okay, so using something, okay, you're taking control of something either via contract or physical control and making sure that this person pays you back, well, whatever this person owes you. Okay, so in the case of the bank, if the borrower owes a mortgage, okay, the banks might offer this borrower mortgage only or condition where they go ahead and say, hey, listen, we'll let you borrow this mortgage as long as you declare on the contract that we'll seize your property, whatever you have right now, your assets, okay, or your first mortgage, okay, in case you're not able to pay us back. Okay, so that way they're making sure that this borrower will pay, will provide accurate information on the application, so on and so forth. Okay, now another way the banks ensure verification, okay, this would be via interest rates. Okay, so this is interest rates. Now the beauty about perfect competition, whether it's perfect competition between banks, okay, or perfect competition between other businesses, okay, you can always look at the market rates when it comes to interest rates, okay, which means you do not have to offer interest rates, okay, just because the customers demand it, but you offer interest rates based on the ongoing rates in the market, okay, when it comes to interest rates that you give out on mortgages, for example. So let's say the interest that the bank collects or the interest rates on your checking and savings account or savings account, okay, where the person who's making a deposit earns interest on the money that they deposit into their account. All right, so this has to do with interest rates. Now, apart from interest rates, okay, another way the banks manage their credit risk, okay, is through loan commitments. Okay, so what are loan commitments? So just like any contract, okay, the banks will require this person, okay, to make monthly payments, for example, along with principal and interest. Okay, the banks may require this person, okay, to commit to a 2-year loan, for example, so on and so forth. So this is loan commitments. All right, so that would be it for this video. On behalf of Electronics, this is Ubaid. Have yourself a great day.